Welcome back to the Catalyst Clock. Quick note, not financial advice, we're not licensed advisors, this is educational analysis only. When a company's free cash flow margin collapses from 21% down to under 10% in a single year, that's usually the kind of headline that sends a stock into a tailspin.
Right, except Warren Buffett's Berkshire Hathaway just wrote a $10 billion check into this exact company anyway. We're talking about Alphabet, and its earnings report drops tomorrow.
So either Buffett knows something the sell-off doesn't, or this is about to get uncomfortable. Let's find out which. Start with the business itself. Q1 revenue came in at $109.9 billion, beating estimates by 22%, with earnings per share more than double what analysts expected.
And that spending is exactly what dropped the free cash flow margin from 21% to about 9.2%. Basically, for every dollar for Alphabet used to keep after expenses, they're now keeping less than half of that. The stocks felt it too, down to around $346, testing support near $341. It needs to break back above the $357 to $359 range to really show it's recovered.
Now, the deal that actually got our attention. Alphabet is raising over $80 billion in new equity, and Berkshire Hathaway is putting in $10 billion of it, $5 billion in Class A shares, $5 billion in Class C.
For context, Buffett doesn't chase hype. When his money moves into a company this size, it's usually read as one of the strongest confidence signals in the market.
On top of that, Google Cloud just teamed up with Accenture on agentic AI tools for mid-sized businesses, and there are early reports Google's developing its own AI chip, which, if true, would mean less reliance on NVIDIA down the road.
But, and this is a real but, Alphabet just lost an 8-year legal battle in the EU. The Android antitrust fine, €4.1 billion, roughly $4.67 billion, is now final.
And it's not just the fine. European regulators are now ordering Google to open up parts of Android to competitors under the Digital Markets Act. That's not a one-time cost, that's an ongoing structural change to how the business operates in Europe.
Add in a delayed launch for their next flagship AI model, Gemini 3.5 Pro, and you've got a company spending record amounts of money at the exact moment its two biggest growth stories, AI and cloud, are facing real headwinds.
So, bring it together. Analysts are expecting $116.9 billion in revenue tomorrow, with the average price target sitting around $432, well above where the stock trades today.
I'd call this a 7 out of 10. The cloud growth and the Berkshire investment are genuinely rare, high-conviction signals. That's not something you see backing a weak business, but the free cash flow hit is real, the EU pressure isn't going away, and tomorrow's report has to prove the spending is actually converting into growth, not just burning cash.
This is a watch what they say about capex efficiency earnings call, not a buy blindly because Buffett did call.
Here's what's worth sitting with. One of the most disciplined investors alive just bet $10 billion on a company whose cash flow just got cut in half. Either that's conviction the market hasn't priced in yet, or it's a bet that takes longer to pay off than anyone's expecting.
We'll know a lot more in about 24 hours. Subscribe so you don't miss it.